everyone. So we are Team 1, and today we're going to present the strategic plan of expansion of Rejuvenating Spa Inc. And for the later presentation, we're going to call RSI for this company. And first, I'll give an introduction to our presentation. So the current status of RSI is they just bought a lavish spa in 2014, and that they're processing in consolidation and looking for expansion. And their overall vision is to provide exceptional client-central spa services and in a relaxing environment, and also maintain environmentally friendly and sustainable manner. So their vision is to provide professional quality services while developing relationship with their clients, community, and the environment. And for Lavish Spa and RSI, they are current vision and mission. It's kind of different from the overall one, but we are going to address that in the later part. So the key success factors for RSI is convenient location and clean facilities, offers up-to-date and unique services, and uses only quality products like organic products, and also competitive pricing, and also good reputation. And in terms of the goals and stakeholder preferences, there are a total of 10 shareholders on the board, but there's only 3 of them are active in managing, and their direction of the company varies. And their current competitive strategy is RSI has been focused on providing quality service, but there's an overall strategy has to be developed later on. And I'm going to present the financial analysis. So before, RSI's financial statements has been prepared for shareholders' use and income purposes only, but not in accordance with ASPE. But later on, they will need to change it in accordance with ASPE, and also consolidated financial statement will be required. And financial statement ratios, their overall financial health is strong. So there's RSI is strong in liquidity, and they're also strong in profitability. But the only concern would be inventory turnover and their solvency, because their debt level is too high. And the bank covenant has a requirement of their debt and equity ratio to below 1, and also the debt asset ratio will be lower than 1/2. So now we're going to talk about the external and internal analysis. So the strengths of RSI is they have highly trained staff, and the focus on the health benefits, and they're environmental friendly while they grow a lot, and their customers are insurance covered, so they don't have to worry about the accounts receivable, and they have specialized packages, and they also have a really effective loyalty program. But on the weakness side, they have shareholders who are lack of experience, and their profitability is not so good, and they have a really high staff turnover rate. And now I'm going to pass to Bonnie to talk about the opportunity and their strengths.
So the opportunities that we noticed was the industry is trending towards a tourism-related spa visit. There's also a social trend towards wellness retreats. And customer loyalty is really due to the intimacy of treatments, so a strong building of relationships is happening. And for the threats, I think we noticed during the economic downturns, people will usually cut discretionary spending, so that would be spa services. And there's a high customer bargaining power and a competitive industry that we are in.
I'm going to talk about strategic option number 1 for RSI, and this is about building a consolidation between RSI and Lavish. Both spas will basically align with the vision for Sally in terms of bringing about better consolidation and drive cost savings by rationalizing the various functions such as finance, admin, and IT, and also help speed up decisions in terms of acquisitions or any other decisions which relate to the management of the company. It will also help with the financials in terms of helping to meet the bank covenants, which is critical. Also help acquire funding for expansion or any other operations. The cons of this proposal is that Lavish's manager is opposed to the merger of the operations due to differing systems. We also have a case wherein Lavish has a bonus structure in place, RSI doesn't. Bringing about consolidation would add to costs and also could potentially lead to employee attrition. And we also have differing accounting policies and customer bases, which can negatively impact both operations if they pursue the option of consolidation. Strategic option number 2 is following a franchising option for all the spas. Now, the pros of this, it is in line with board's growth mandate. It is an effective method for capturing market share, and also helps in the expansion of the spas into new markets that RSI never approached. It also helps in gaining operational expertise because the franchisees can provide more expertise on areas that RSI is not strong on. From a cons perspective, there are different value structures that the franchisees follow and could damage the long-term brand for RSI and Lavish. Expansion could overwhelm the CEO, and she doesn't have the support structure to help manage the company when we follow the franchise model. And location constraints, be it from a cost perspective, could impact profitability along with the footfall. Now, both these options, number 1 and 2, are not cost intensive, will not result in increased finance requirements. So it is something that the board needs to consider while they think about expanding the operations.
RSI has the option to form a partnership with FFL to operate a massage therapy center. This option is of low risk because RSI can share the cost and initial financing with FFL. And this option also provides opportunities to the therapists to train new therapists and to creating training menu. And it also adds diversity to RSI's current situation and also provide more financial stability. And based on our quantitative analysis, this option is also will be highly profitable. However, RSI is not getting brand promotion through the operation of the partnership with FFL, and it will be highly dependent on FFL's financial stability, and additional expenses will be incurred depending on whether this operation is a partnership or a corporation. And thorough due diligence is required to ensure that the information provided by FFL can be trusted. RSI is also considering the option to acquire Pure Substance Inc. And the integration between the two companies can generate synergy and reduce cost. And it also will allow RSI to improve its brand image as being environmentally friendly. RSI will also increase its growth potential through expansion into the large retail chains. And from the quantitative side, this option has the potential to be profitable. However, on the other hand, RSI does not have the experience to operate a manufacturing operation and also does not have the expertise in organic spa product. And the increased foreign competition will affect the RSI's profitability. And the cost to produce relative to revenue has risen significantly in the recent years. And this option will also cause ethical issues that the the Pure's management has made significant obligation to the employees, while the more profitable option is to outsource to a larger company.
So to conclude, I'm going to first go into conclusion, then we're going to talk about some of the recommendations, we're going to talk about the implementation plan, and finally going to talk about the financial forecast and financing options. Recommendation number 1 was to consolidate RSI with lavish operations. This is recommended because it would seem to be beneficial. However, we want to only consolidate the financial and operational side, and we want to keep the spas separate, so to still have 2 separate spa styles. Recommendation number 2 was franchise. This is expected to be profitable, and we will recommend to still go ahead with this. However, we like to wait at least a year before doing so because it requires a lot of startup costs. Recommendation number 3 was to partner up with FFL. This again is an option that's highly recommended because it's going to be likely very profitable. The cash flow generated from this option can then be used towards the ventures such as franchising, and we will probably like to start with FFL first. Recommendation number 4 is to acquire Pure. This is not recommended because currently Pure has a deteriorating financial state, so it would be very risky to take on this requirement. Next, we want to talk about the implementation plan. So, based on the options that we have decided to go with, we like to consolidate at RSI and Lavish immediately, and Sally will be leading this implementation. Franchising, we want to wait minimum 1 year, and with partnership with FFL, we like to start immediately, so once this starts generating positive cash flow, we can use this to start franchising. Next, we want to talk about the financial forecast and financing. First, we need financing that's going to be required. So the bank covenant currently is not met, and we recommend to go with Blair Cummings instead for loans instead of the bank. Final conclusion summary is to consolidate with Lavish, partner with FFL, to go with the franchising option but not to acquire Pure.
After the consolidation of RSI and Lavish, there were operational issues that we noted that might occur. However, we indicated possible solutions as well. So as the companies merged, we've come up with an updated mission and vision statement. The RSI's new vision is to become the reputable leading spa for Canadian spa goers by growing RSI's brand geographically. RSI's new mission is to provide exceptional client-centered spa and therapy services to enthuse clients in an atmosphere that is relaxing and in a manner that is environmentally friendly and sustainable. So some of the management performance issues that we noted might occur. We found that the balanced scorecard will actually help to align the business activities and operations of RSI with the strategic goals of the shareholders. This could also be used for performance metrics, such as the percentage of revenue from new sources, number of complaints received by the corporation, and utilization rates and attendance at workshops. Another thing would be corporate structure. We would maintain separate set of managers to maintain the separation of 2 brands. The only change is going to be combining the core support functions such as administration and accounting. So the monitoring shift will be from separate entities going over to an overall performance of the spas. The administrative functions, we will be also using one information system across all spas, so that will help share customer information and help with facilities referrals and reduce costs. Additionally, accounting and financials might be a little bit harder to work with, but we will be using a standardized accounting standard so that it will be easier to report, and we recommend using ASPE. And also the employee bonus, which was such a big hit prior, we will actually keep that, and we'll break down the bonus scheme between 2 levels, manager and above, and below manager. And for manager and above, it will be equity ownership, and for the managers and below, we'll actually increase, we'll be continuing with the monetary and vacation bonus, which will increase the expenses. However, the long-term benefits will really justify this increase. The governance, we also recommend that we actually start a conversation with Blair Cummings to have him come be a part of the board, also by converting his debt to equity, so that he can actually guide the financials because he has a strong financial background. In conclusion, our presentation evaluated the major business opportunities that are available for RSI, and we recommend that the company consolidates with the subsidiary Lavish Spa and pursue the partnership with Forevermore Fit Limited and franchise out RSI's brand on its own. This strategy ensures that the board's goals are met and RSI continues to grow and prosper. Thank you for listening to our presentation.